Welcome, clients and friends, to Credo and Winthrop's fourth quarter market outlook. And we have Adam Coons and Freddy Lavric here, and they're the portfolio managers. So we're going to ask them a series of questions. Can you guys give us a recap of capital markets in 2023, along with what worked and what didn't?
Yeah, I'll start off, and then Freddie, if you want to kind of pick up the pieces. Obviously, coming into the year, there was quite a bit of pessimism. Most economists believed that we would see some form of a recession, and we kind of kept waiting to see that play out, but it just frankly never did. And so that led the Fed to continue to raise short-term interest rates. So that kind of had this push and pull effect on the markets. But largely, it was kind of a low volatility year across the equity markets, at least. I'd say fixed income markets were somewhat heightened. But we still ended the year with, the S&P 500 up over 20%. And as we'll kind of talk about, that was, largely driven by just a handful of stocks. So somewhat of a difficult, perplexing year, despite the fact that the returns were actually pretty good. So all in all, despite some of those headaches, it was a good year across capital markets.
Yeah, as Adam said, the S&P finished up 26%, despite wars going on and inflation going over 8%. Just to speak on small cap and mid cap a little bit, they were both up 13%, so we saw growth there. In terms of growth versus value, growth was up 25% and outperformed value by about 150 bips. And then on the international side, we saw the IEFA up about 15% as well. So you really saw a good year across the board, really. To get into sector specifics, basically the S&P was led by tech and consumer discretionary. Those sectors were both up 50% for the year. And the laggard was utilities, which fell 12% for the year.
So what is your outlook on Fed policy and its impact on the markets?
Yeah, so I'll start with what the market believes is that we're going to see rate cuts, at least 3 this year. That's really going to be driven by the fact that the market believes both inflation is going to decline and then employment is going to become slightly worse. And so that would drive kind of a Fed narrative of taking their foot off the gas pedal of this tightening cycle. I think, and we're a little bit torn in the shop, and we're going to have to kind of tease this out a little bit. But I think really what we see is that the Fed's going to be a little bit slower to change their position than what the market thinks. And if you look at what the Fed's done over the last several years, they use this transitory narrative as inflation started to tick up, basically saying that this was going to be short-lived, wouldn't be that bad. And so they were very slow to increase interest rates. And so we believe that on the flip side of that, they're going to have a slow stance on, cutting again. Because the last thing they want is to start cutting, and then we see inflation pick back up, and then they have to raise interest rates again, which we've seen historically a couple of times when the Fed's been too aggressive in either direction. So I think realistically, we'll probably see a rate cut this year, but maybe just one. Like I said, really driven by the fact that the Fed will be slower to act despite inflation, declining, or there's some sort of disinflation where that rate of inflation is getting lower.
And so if you think there's one cut, when do you think that'll be?
I think it'll be towards the end of the year, likely fourth quarter. It may come in the third quarter, but it's really going to take hard evidence that the economy is slowing sharply, that inflation is dropping very, very quickly, and that some way that the Fed can feel sound that their job is done in this tightening cycle that we've been going through.
Okay, thank you. So how have you guys adjusted the portfolio allocations going into the new year?
Yep. So basically, tech had a huge rally at the end of the year, up almost 40%, and the NASDAQ was up almost 40%. So given that rally, we really see some outperformance coming due to smaller cap stocks. So the way we're taking advantage of that is by allocating some of our models to RSP. So this is an equal weighted ETF. And what it does is you're taking an overweight in smaller cap stocks and simultaneously taking an underweight to the big tech that is now largely overvalued moving forward. So that's one way that we're playing on this the trend towards the end of the year.
Okay, that makes sense. So are there any sectors of the market that you expect to outperform in this next year?
Yeah, so one of our favorites is actually healthcare. Healthcare last year finished the year down 6%, one of only 3 sectors in the negative. In terms of PE, it was trading at 19 times, which is slightly undervalued to its 5-year median. And what we like about healthcare right now is that one is momentum. So we're seeing a lot of momentum in the GLP-1 space, which is basically what Lilly is experimenting in terms of weight loss. And secondly, we're seeing biotech valuations that have dropped significantly. And what this does is it leads to bolt-on acquisitions for many companies that we've seen. We've seen Bristol Myers, Pfizer, and Merck have 2 to 3 acquisitions just over the last couple of months alone. So we're seeing M&A pick up again, and it was very, very negative back in 2022 and 2023. So for those reasons, we think healthcare should be in for a good year.
So what is your take on the large cap tech sector? Is it too late to buy NVIDIA?
I think I'm going to use a broad brush here in tech. There are kind of 2 different forms of it. And there are those companies that are still growing, and they're growing with a business model that is not reliant on the AI, push that we've seen. And when I say that, is largely because what we've seen so far is that most of the AI story is just that. It's a story. We haven't seen any real evidence of how that's going to be monetized. We know it is going to be monetized. It's just the matter of how big it will be and what companies will actually win through that. So we still like tech, but we're more specific in the names that have a more robust business model per se. When you're looking at someone like Alphabet or Microsoft, for example, they're obviously not the flashy names, but we think that those can continue to outperform. Where we're seeing some concern is in a name like Apple, where there really is no real catalyst for growth. And the catalyst for growth was going to be China, but that seems to be fading. And then to your specific point on a name like NVIDIA, we are more cautious. Now, we're not moving completely out of the name. Obviously, in general, we do like the chip sector. NVIDIA has seemed to have kind of run a little bit too far. The valuations are difficult to make complete sense of. So we would be cautious on it, but we wouldn't move completely out of it. Freddie, would you say anything additional there?
No, completely agree. We're basically cautious and very selective on the large cap names that we're currently owning in our portfolios.
I would say that through that caution, it may come as no surprise that we're picking the more defensive tech names. And when we say that, it's that they're lower debt companies. They have a larger free cash flow. They have positive earnings and do still have some level of revenue growth. But we are staying away from those companies that have no earnings at all, or we're seeing declines in revenue or free cash flow.
Okay, and then do you see any investment opportunities in China or Europe?
So starting with Europe, and then I'll let Freddie discuss China. And I'm also going to wrap Japan into that with Europe. I know it's really just talking about developed countries and talk relative to the U.S. We still see the U.S. In the developed investment markets as the best place to be. It's really driven by some large items like demographics. When you look at Europe and Japan, there just is a demographic wall where you have a more aging population. The fertility rates are extremely low, and that just doesn't bode well for growth. So we think that Europe is going to continue to struggle. Obviously, the conflicts that are over there don't help that situation. Frankly, we think that some countries like Germany are already in a recession. And then Japan, we just see that as a difficult space in general. I think, it's probably number 2 ahead of Europe, right behind the US. But like I said, the demographic issue is just a hurdle that's really difficult to overcome. And that's why you've seen interest rates either at 0 or negative for so long, because they have, rather than an inflation problem, they have a deflation problem. And that's much more serious of a problem for an economy than inflation. So until they can kind of shift, and that's obviously a demographic shift, takes a long time. It's just hard for us to see how Japan outperforms the U.S. on a relative basis.
Okay, and then I have another question here. So let's see. I was just reading that the Chinese company, is it BYD, is now outselling Tesla in terms of electric cars. So number one, would that potentially be a good investment? And second part of my question is, we heard such a big hype about all the materials companies for cobalt and lithium and all the materials that go into making batteries, and they just did terribly last year. So what's your outlook for this year?
So to your first questions, BYD, it is actually outselling Tesla now in China, and we see that as a good opportunity in general, along with the other Chinese tech companies. When you essentially, China has been quite a difficult investment over the last 2 years, and no surprise there. But when you really search the globe over, it still remains one of the most attractive valuations. At 12 times earnings, if you look at historical valuations, it's closer to 16, and it even reached highs of 21 just 3 years ago. So we definitely see opportunity there based on regulations are no longer as strict. Obviously, the reopening is still occurring. And China has basically really gotten behind these tech companies now, as opposed to where they were at 2 years ago.
There was a big hype in 2022 about all the essential rare earth minerals that go into batteries like cobalt and lithium. And and I guess copper too, did horribly last year. What's the outlook for this year?
So that really played hand in hand with EV last year. We saw really big, safe companies like Albemarle fall over 30%. Our outlook is that valuations have cratered in the lithium space, but we're fairly bullish of a recovery. So names like that are pretty attractive in our opinion.
I think it's important to keep in perspective that, rare earths, just as a whole, what they tripled the previous year. So I think a lot of what we saw last year was just that natural, just kind of version to mean. So I think even with the decline, you're still over a 2-year time period, you're still up 100% on a lot of those types of metals. So I think that's really the perspective of the sector as a whole. I do think obviously these are materials are going to need to be used at a greater capacity. So there is still, like Freddie said, especially with these valuations, I think it's a positive sector to look at.
Okay, got it. So anything else you think that our clients and viewers should know about?
I think just to kind of wrap up on just the asset allocation, I think we do really like where we are right now from a mix of stocks and bonds. I think one of the things you'll see is, one, we do think interest rates ultimately will continue to decline. So where we do have fixed income allocations, we do want to kind of get longer maturities into the portfolio so we can lock in that yield. We have kind of had a tilt towards shorter maturities in our models in the past, because we did have an outlook that interest rates would rise. So now is that opportunity to kind of flip that script. And then conversely, on the equity side is, to stay more defensive. We're not by any means reducing the equity allocation, because I think there's still a lot of positives out there. I think valuation is really the only real big negative that I see. Obviously, GDP growth next year is only set to be 1.5%. So I think you got to lower your expectations for equity returns, especially after a year that's up over 25%. And then also, like I said, moving more defensively. So not necessarily selling stocks or equities, but just moving towards a more defensive tilt, I think is a better move going after, coming out of a year where stocks are up large, valuations have gotten a bit stretched.
Got it. Great. Well, thank you so much for the update. Appreciate it.
Yeah, thanks for having us.
Keep up the good work.